Today, we're going to be talking about how to prepare a multifamily property to go on the market and sell for the most amount of money. There's a lot of operators that scramble at the last minute and then slap it on the market, and then they're surprised when they don't sell for the most amount of money. And today, what we're going to do is break down our 12-month right up to the sale point to be able to maximize the amount of funds, the equity that we pull out from that property when we go to sell. John, it's great to be here with you.
Great to be here, Mark. So I know you were traveling recently and had the opportunity to go to the Best Ever conference. How was it?
Yeah, Salt Lake City. I mean, what a pretty city. We're the Hyatt right downtown Salt Lake City. You look out the window and you have mountains all around you. A little cold up there. Not as cold as Toronto.
Yeah.
But being down in Naples, Florida, Salt Lake City is pretty chilly. So had to bring a jacket. But the overall, like the message that was received across the board is that multifamily is at an all-time best time to buy right now. The consensus is we're starting to hit the bottom of the market. More and more operators are getting forced to come on the open market and sell because the lenders are pushing these operators that are, we'll just say, they're from a debt service coverage ratio. The banks and the lenders have been blending and pretending with the loan, and they've been turning a blind eye, but they're starting to clamp down more on operators. And what was also interesting, I found, John, is that, you know, a couple of years ago, I'd gone to the Best Ever conference, and multifamily was, everybody was talking about it, right? It was like it was the sexy asset
Yeah.
to invest into. And today, when I just got back last week from this conference, and it was interesting because there was other asset classes that were being talked about, and there's like multifamily wasn't as of a sexy asset to be investing into, and it was really interesting that the shift and the change there. And so that just tells me that when an asset is not as sexy, that means you're starting to hit the bottom of the market. And so if you really follow through on your business plan and you execute on the business plan, your cost basis coming into a market where it's not as sexy is you're going to do a lot better if
Mm.
you're doing all those things and you pick it up at the right cost basis. And that's what we're seeing out there in the marketplace, John. As you know, we're starting to see some deal flow come up, and I'd like you to maybe tell the listeners a little bit about what we're seeing from a deal flow standpoint. But that was a theme that I noticed in this conference, is that multifamily, with a lot of operators, there's a lot of people that got stung in the industry because they will just say over leveraged themselves. They got adjustable rate mortgages, and then with the rates going up so fast, a lot of them with their properties are not in a good position. But because of the way that we're structuring our deals today with multifamily and the cost bases that we're buying today, like I'm more excited about multifamily than ever. But why don't you tell a little bit about what we're seeing in the marketplace for deal flow?
Yeah, absolutely. So, I probably overused this quote on this podcast, but the famous Warren Buffett, right? When everybody's scared, get greedy. When everybody's greedy, get scared. And I think to your point, a lot of operators in that greedy market weren't scared enough, right? And they thought the party would never end and the low rate environment would persist. And of course, nobody could have predicted the pandemic. And so, for a lot of operators, I can understand it. There was 10 years of low rates, right? And why would they change? But that black swan event came in and caught a lot of them flat-footed. And so, for us, we're actually more excited about multifamily now than I think we've ever been. And part of that is a direct product of the deal flow we're seeing. So, we have seen a notable increase in actual deals hitting the market. So we track every single deal we receive, Mark, right? As you know. So even if it's outside of our buy box or in the market, we don't look in, but we just want to be able to say, okay, how many deals historically have we gotten in January? How many deals have we historically gotten in February, in a month to month? And then we break it down by market. And so, in every market we're looking for deals in, we've seen an increase over last year's volume by about 20%. So that's been great. A lot of those deals are still quite large or new vintage or 60s and 70s vintage. So not necessarily in our buy box, but that's a great signal. But the best part is we're actually in a place now where we're actually having to pick and choose which deal we're going to pursue. And I don't think we've ever seen that since we started in 2023.
No.
It's normally like we've got one deal and we better wrap our arms around it and not let it loose. And so
Yeah.
we're actually at a place now where we're like, shoot, there's two we like in one market, but there's this other one we like in this other
Yeah.
market. What do we do? Right. And so
Which one do we
it,
like
it,
better?
Yeah,
Right?
yeah. So it
Yeah.
feels good to be in that position. And just for the people listening, we've submitted a few LOIs. We've got two actual active LOIs that we made best and final on. So we're hoping to make a selection on one of those here in the coming weeks, if not sooner. But even some deals we looked at last year that the seller was not willing to accept our pricing. The bid ask spread was still there was still a gap there. Seller was a bit unrealistic about the market. We're starting to get some calls from those brokers saying, hey, the seller's getting a little more realistic. So we're in a very good position here. The key for us is just being very thoughtful and selective on which ones we do choose. Now, to be clear, it's not like we have 100 to pick from. We're talking about 4 or 5, right? But it's like, it's a good place to be where we actually have to make a decision on which one are we going to pursue versus we love this deal and we better not let it loose. For the listeners too, look for our next episode after this one drops because we're actually going to get into the cycle and what's occurred and when market values peaked in multifamily, where they hit the trough, and now that they're on that upswing, what that means for you as an investor. So you don't want to miss that episode. But we're really excited about the market today, and we have a big goal. We want to acquire 5 to 6 deals this year, which would effectively double our volume. So we're well on our way.
Yeah, right on. Well, today's talk, we're going to get into what we do to prepare a property for sale to get the most amount of money. Now, there's 3 different exit paths that you can do. You can either sell the asset, is what we're going to be talking about. You can refi the asset, as in refinance and pull equity from the property. And then last but not least is just hold the property and actually just cash flow it for long term. And a lot of operators will hold properties long term, and I think that's a really great approach. The assets that we've taken down so far, our approach is to buy, renovate, and then we're looking to exit and sell those assets to be able to get really strong wins for our investors. And so that's where we're going to be talking about, like, we have everything mapped out in regards to not only our acquisitions. We're big on systems and processes, but also the business plan execution, and then coming into a sale. We are getting closer to that point where we're going to be looking at exiting a property, and we have that all mapped out. So, starting at 12 months, 9 to 12 months out, we want to really focus on finishing the capex, so the renovations, and making sure any last renovations are done. We're not leaving it to the last minute, so that when buyers are looking at the asset, we want to make sure that any renos that we do, we start generating income on those renos, so that it actually shows up on in our net operating income, because the values are really factored. They factor in what the income is coming in on the property. If you do a capex or renovations, and you don't lease that up before it goes on the open market, you're not going to get credit for that renovation. So we want to make sure we're doing this not in the last month, but we're doing like 9 to 12 months out, so that it shows up in the T12 when buyers look at, okay, what's the last 12 months of your profit and loss statement, so that they can see, okay, income is stable here, and then they're going to give you a higher valuation on the exit.
Yeah, that's right. It's really that 12 months to 9 months is building that durable net operating income story, right? So it is about telling a story. So we're not only, finishing our capex, getting those renovated units rented, but we're also doing some delinquency cleanup, just making sure our rent roll is tight. So if anybody's behind on rent, we're either tackling payment programs or potentially moving towards eviction, making sure our collections are up to date, and even going back to our vendors and having a performance reset, in other words, renegotiating the contract. So another big factor in that period of time, and this is something we're always doing. In fact, every one of our property managers at the property level has a monthly review goal, but we're making sure our online presence looks super tight, our resident surveys are clean, people are excited, and the curb appeal's tight. And then we kind of transition into like the next phase, right? Month 9 to 6, right? So then it's all about making those financials bulletproof. So normalizing any one-off items, making sure our payrolls, at market where it needs to be. Looking to optimize those other income streams, right? So if you're newer to this style of investing, yes, rent is the biggest component of your net operating income, but there's programs like valet trash where we're peeling a little profit off of that. And it's a service that we add to our residents. So things like potentially reserve parking, making sure our allocation of utilities is appropriately allocated to the resident, right? That's called RUBS. So ratio utility structure. So, every municipality has a set rate that you can charge back. And so just making sure we're maximizing that. And then going back to our contracts, right? Rebidding trash, landscaping, pest, internet, and just making sure we have the lowest possible cost going in. So our net operating income is super strong.
Right on. And then we're getting to that T6 to T3. So 3 to 6 months out, we want to do full unit walks to be able to ensure all the interiors are done up to our standard and that we are maximizing the rents of all of the units. So this is an ongoing thing that we do, but we just want to make sure we're not, missing anything. So those
Yeah.
unit walks are something that we're actually going through and making sure to catch anything. So we're not leaving it to last minute in case there's something that needs to really, maybe you got to order something in and it's going to take a little longer. You don't want to leave it till last minute. You want to make sure that everything is compliant from an inspections, any final permits or certificates. You want to make sure that all that is wrapped up so that the buyer's not going to find anything at the last minute where
Mm,
it's like, closing is prolonged because you didn't wrap up some of your documents, like your inspections or open permits or whatever. You want to make sure that your title is clean and there's not going to be anything that pops up. And then we want to make sure we're going through all the maintenance logs and making sure that any we'll say issues when it comes to maintenance are looked after, and we have a very clean maintenance log because that's going to be something the buyer's going to want to see,
yeah.
and we want to make sure to clean that up and proactively hit it so we're not having constant issues that show up in the maintenance log that the buyer's going to see when they go and purchase the property. So that's between T3 and three T6, and then John, maybe you can take us the last little bit of the way of right like 90 days before we're
Yeah.
going on the open market. What's kind of the last thing that we want to make sure to do?
Well, in line with what you just mentioned, right? Part of what we're doing when we're reviewing these maintenance logs, and we're really building the story out. So documenting and putting everything. Now we're already sort of doing that. We're very organized. It's just who we are. So everything that we have related to that property, any vendor contracts, any repair work, any renovation work, we're logging that. But getting that package together because the buyer's going to want to see all that. So kind of in that month 3 to kind of 0 hour when we actually list the property, it's all about kind of the marketing side of things, right? So getting professional photos done, making sure the property has a clean tour path, so when the broker's showing the potential buyers the property, it's a curated, thoughtful process that broker's taking them on. We have a very similar thought process with our residents, but we want to apply that same thinking to a buyer so they see the best of the property, and it's that best first impression. Making sure our model is staged and looking perfect with our branded scent and our branded music. Leasing office needs to be spotless. Our signage needs to be in great condition. The hot Florida sun can, sometimes bake your signage a little bit, right? Not our monument signs, but some of the other signage we have around the property. So potentially replacing that just so everything is polished and just beautiful. Amenities up and running, right? Making sure there's no issues with the pool. I mean, Mark, you and I have literally toured assets where the pool is not functional,
Yeah,
and in my brain,
yeah.
it's just like, I can't wrap my mind
Or
around
full
that.
of leaves, and it's a
Yeah. Or
mess.
green,
Yeah.
mildew or whatever,
And
and it's
we're
like,
talking like $20 million assets. Like
yeah, yeah,
you go and sell a $400,000 home, and you're spending thousands of dollars on staging and preparation. Like it's really surprising. You're selling such an expensive asset. Like just spend a few dollars and just get it prepared so when buyers are actually walking through, I know that they look at the numbers, but there is still an element of looking at the overall maintenance, and they're going to associate x amount of dollars for when they come in. They're going to need to allocate to that, but if you can fix it ahead of time, that's only going to help position yourself to be able to get top dollar. And like 1% difference on a $20 million property is a lot of money.
that's it. And finally, kind of in the part of that process, we got our data room together. So we actually build out like a shared drive where we have, the leases, the ledgers, all the contracts, utility bills, warranties, surveys, just anything that, our property condition assessments, just locked and loaded and ready and available. Um, Personally, as buyers, we request that information within 5 days of going under contract, but we've worked with some sellers where we get that immediately, and it makes such a huge difference. And for me as a buyer, it actually is a reassurance factor where, for example, when we don't get it or it takes a while to receive it, you start kind of thinking, is there anything else this operator is going to be slack on or lax on or behind the curve on? And so, what you want to avoid is a retrade, right? So having everything just available and ready so that the person who's buying it can make an intelligent decision. And then, we're basically at execution point, right? So once we list that property, and this is another issue we've seen, and actually our first deal we bought, between the time we went under contract and when we closed, they allowed occupancy to dip, and it impacted us negatively in that we
Yeah.
actually had to have a lender reserve, right? So just keeping occupancy and collection stable while the property is on the market, and just constant contact with the on-site team, just, normal operations. We're continuing tours, we're giving notices to residents that are behind, leasing issues or payment issues, and our maintenance are still super tight. In fact, in a sense, I almost want to deliver the property to that buyer in better condition than they found it in, right, at closing, right? So it just makes it easy because, one thing about this business, Mark, as you know, is the longer you're in it, the smaller it gets, right? The fewer people that hang out for a long period of time. And so your reputation is super important. And so we want that reputation that we're great operators, and buying a deal from us is a pleasure, not a hassle or a problem, right?
For sure, and even for the broker, if we can make it their job easier, then they're gonna really like our assets, which means that in future deal opportunities, they're gonna be more lenient and more, let's call it, leaning towards us versus another operator, because they know that we're likely to come back and allow them to sell the property for us. And when we do go to sell it, we're not going to be, this operator that just hands over, a poorly run asset, and we're going to make their job easier from a marketing standpoint. And I'll just say that, John, this is, I would say, one of the strengths that we have with your background and my background being in the residential real estate space, that we've staged and sold thousands of properties from our own perspective. And so this is where we understand, you know we'll say, what potential buyers, the emotions that they go through, and we understand presentation and marketing, which is, you got to sell the story. But when buyers are walking through, you want to be able to get ahead of any potential objections. And a lot of this stuff is not even a lot of money. Like,
Right.
we're not even talking about substantial sort of investment. It's just attention to detail.
Yes.
And it's the detail is what gives a buyer an overall feeling when they're looking at a couple of assets. They're looking at the financials. Of course, that's going to be a vital, important part. But if we do a better job at creating the story and the presentation side of it, and then we partner up with a broker to be able to get the message out there in the right way, this is how you maximize an asset's value, and you deliver higher returns than another operator that's not doing all these things.
That's right. So this one will be a bit of a flash section, but when is it a good time to sell? So there's a few key things we look at now. When buyer, sort of depth starts to expand, in other words, there's more qualified buyers out there, tighter bid ask spreads. So, speaking with brokers and they're like, man, we list the property, it sells quickly, fewer retrades, right? So the market is just favorable. Now there is another time, which is a market not unlike today, where there are maybe fewer active buyers, but there's also a deal issue, right? Where we're not seeing as many good deals as maybe we were 4 or 5 years ago. So you don't want to always wait for the perfect time to sell, because you might miss a great opportunity to sell today, right? So, but more qualified buyers in the marketplace is number one. When debt liquidity improves, right? When there's more loan options out there, better DSCR terms, more leverage, and obviously lower rates. That's a great time to be looking. When we're starting to see cap rates stabilize or compress. So when the comps are showing the cap rates are coming down, that capitalization rate being the ratio from the net operating income and the sales price, right? So the lower the cap rate, the kind of the better time to sell. And granted, when you have a higher cap rate, you might achieve more money, but that means the market is more challenged. So it's kind of looking at what we are going in cap rate was, and is it around the same, or is it starting to compress, time to sell. And then rent growth versus expense growth, right? So when we're seeing rent growth outpacing our expense growth, that's a great time. And then also just supply pressure in that market. So what I mean by that is that if there's fewer new deliveries coming into that market, that's a great signal. So
Mm.
what we're starting to see in the market today is, for example, some of our deals that we bought in 23 and closed on in 24, we're not quite today there, but we're in that kind of, are we in that 12-month period where we need to start planning and plotting? And the reality, Mark, as you know, is when we take down these deals, we kind of map out the full 5-year hold period. And, our goal is to get that money back to our investors as soon as possible, but at the maximum return. So that could look like 2, 3 years in, right? It just depends on what we're seeing in the marketplace, all those things I just mentioned, and at the property level. So we're always thinking about it. But, right now with some of our early acquisitions, we're starting to kind of go, okay, is this 12 months out, 18 months out? Let's start planning. So, for example, at our Largo and our Charleston portfolio, we've actually turned the speed up a little bit
Mm.
on our unit renovations because we want to maximize that NOI as quickly as possible. So we've actually taken a little bit lower occupancy for a 30, 60-day period, renovating all those units. So we're maximizing that NOI. So for our investors, the best news is if we hold it for 2 more years, that NOI growth will continue. But if there's a great time to sell, we can execute in that period, knowing our NOI is optimized.
For sure. And we're always looking at, okay, what is the best move? Do we hold, do we sell, or do we do a refi? When we go into these assets, the last six that we've closed on, the business plan has been to buy, hold, renovate, and then looking to sell in that, we'll call it 3 to 5 year time frame. So we're always looking and analyzing. And, currently right now, we're in a marketplace where it makes a lot of sense to be buying and acquiring properties. Like we're getting them at phenomenal cost basis. I mean, we're looking at an asset now, it's like $115,000 a unit, like
Yeah.
80s vintage, like really, really nice. Like replacement costs to replace that, you're spending over $300 to $350 a square foot. You're the reality is you're buying them at a great price right now. So this is not, you're not going to see a lot of exits, so to speak. And so the question then comes, John, is like, well, why are these sellers selling in a down market like this? Well, there's two big reasons. Number one is they're in a financial position where they want to free up some cash flow. Okay, so that's one. But what we're also seeing is that there are operators that have owned the asset for a number of years, we'll call it 10 plus years. And what they're going to be selling it for, even though it's dropped 20, 30% from the peak of the market, they're still doing phenomenal. Like the return from when they bought it 10 years ago till now, they're still getting a really good rate of return. And so they're happy with the price. And it's just for them, it's time to sell. Maybe their loan is coming up for maturity and they're looking to sell the asset and move along. And so these are the big reasons why people are looking to sell, which is for us, this is the buy time. But moving forward in the next 12, 24, 36 months, we are constantly looking at, okay, do we start to see the market shifting where we're seeing an increase? And if we sell this asset, do we think we can redeploy the equity from that asset that we've already gone in and made better and improved and redeploy it in another asset that is, we'll say, being operated not at the same levels we're operating our assets, where we can go in, improve it, increase overall equity in that, and then look to sell? And that's what our overall business plan is: a constant and never ending assessment of what's the right thing to do: sell, refi, or continue to hold.
That's right. So just to wrap it up, some common mistakes that an operator can make when exiting: they don't really build a compelling net operating income story. In other words, they don't really execute on their business plan. Maybe rents are rising organically, so they don't do that amenity refresh or that exterior refresh, right? Maybe they slow down their unit renovations. So for us, we want to build a very durable story, as I mentioned earlier, and actually create a scenario where the next person can come in and kind of finish that story and see some increase, right? Leave a little meat on the bone for the next person. Another factor, they just let delinquency or poor operations creep into the deal, right? And so just you got to optimize and maximize every opportunity. They might overstate rent growth, right? We have seen that. Sometimes you get, the rent roll and then you look at the financials and just they're not matching up, right? So it's just got to be true and accurate and flawless with our financials, and everything's got to match up. Obviously, things that a buyer could be impacted by: insurance will often go up when a deal closes, and that's going to impact that buyer and the price they're willing to pay. So if we just, think that their insurance, in fact, we had a deal we were looking at in South Carolina where exactly that happened. The guy had owned it for 30 years and insurance was dramatically lower than what we were going to pay. And when we showed them that, because we have a tax consultant that gave us that number, they said, well, it's not my problem. Well, it is. And the deal's still sitting on the market 6 months later, right? Because every buyer is going to have that same impact. And then the lastly is just poor data room, right? If you have bad data, you're going to have fewer bidders and weaker pricing at the end of the day. So to wrap it up, that's our model for executing on an exit or deciding whether to refi or hold.
Right on. And if you're looking to learn a little bit more about partnering with us, and especially at this time, there's such great opportunity to be purchasing multifamily in some of these high growth markets that we're looking at. You can go to fulloutinvesting.com and find out a little bit more about our 10-step full out investing process. And you can go ahead and book a one on one Zoom call with us to be able to get a better understanding if this is a good fit, to be able to jump in on our next opportunity when it presents itself. So thanks for listening. If you enjoyed the show, you can go ahead and subscribe to the channel or share it with another high net worth investor that you believe will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.